Good afternoon and welcome. I'm Heidi Jeffrey, a partner with Foley and Lardner. I'm pleased to welcome you to today's web conference titled A Dive into Recent Regulatory Actions Impacting Healthcare Borrowers. Presenting with me today are Mike Bailey, Dave Bannard, and Matt Swafford. Mike is a partner and business lawyer in Foley's Chicago office, and his practice focuses on tax advantage financing, including tax-exempt financing and tax credit transactions. Mike joined the firm from the Internal Revenue Service, where he served as counsel to the Assistant Chief Counsel for Financial Institutions and Products. He was one of the principal authors of the major federal income tax regulations concerning tax-exempt bonds, including the arbitrage regulations and the private activity bond regulations, and he reviewed or authored most other administrative guidance issued by the service on tax-exempt bonds from 1990 through 1997. Mike is currently chair of our firm's healthcare finance practice. He is past chair of the IRS Advisory Committee on Tax-Exempt and Government Entities. Also with me today is my partner Dave Bannard, a fellow business lawyer in Foley's Boston office. Dave is an experienced bond lawyer, having served as bond counsel and counsel to various parties to bond transactions, including borrowers and underwriters and in-house issuers counsel. Dave focuses on transportation and healthcare finance. Finally, last but not least, Matt is a managing director and partner at Melio and Company. Matt has over 25 years of experience in healthcare investment banking, servicing the strategic and capital needs of not-for-profit healthcare organizations. His client experience includes financing and advising a wide variety of health systems, academic medical centers, children's hospitals, and community hospitals nationwide. Matt's expertise encompasses tax-exempt and taxable financing, credit strategy, and enterprise risk management, and affiliation structures and mergers. Before I turn the presentation over to our speakers, I would like to go over a few housekeeping items. Today's program will last approximately 1 hour and 15 minutes, followed by a short question and answer session. We encourage you to submit written questions during the program. Please type your question into the Q&A widget open on the left-hand side of your screen. We will respond to written questions at the end of the program, time permitting. The webcast console you are looking at can be completely customized. You can resize or move any of the windows that you have open, including maximizing the PowerPoint presentation on your screen. If you experience technical difficulties during the presentation, please visit the webcast help desk by clicking on the Help widget below the presentation window, which is designated with a question mark icon. The PowerPoint presentation will be available on our website at Foley.com in the next few days. As a reminder, today's program is being recorded and will also be available on Foley's website in the next few days. CLE credits are being offered for this program. We will be announcing the 5-digit codes at some point during the presentation. Those seeking Kansas, New York, and New Jersey CLE credit are required to complete the attorney attestation form. Enter the 5-digit codes that will be announced during the presentation on the form and return the form to Kristen O'Neill at KONEILL@Foley.com immediately after the program. And now we turn to the main portion of the program. Today's agenda, which we view as very exciting, will cover 2017 market activity and a look into the crystal ball, a review of recent executive orders, which, as we all can attest to, are adding to the uncertainty of the markets, the proposed amendments to SEC Rule 15c2-12, recent SEC enforcement actions, the MSRB's proposed amendments regarding QSIPs, Then we'll turn to some tax initiatives, including IRS Revenue Procedure 2017-13, focusing on management contracts. And we'll end today's scheduled program with a review of the IRS issue price rule. I'll now, as I've introduced today's presenters, I'm now delighted to turn the program over to Matt, who will give us an insight into market activity and a look into the crystal ball. Matt?
Good morning or afternoon, everyone, depending upon where you're calling from. This is Matt Swafford, and wanted to just make a few comments regarding the current market for tax-exempt and taxable debt for healthcare borrowers. It is still very attractive in the current market to issue bonds, as we're seeing with continued issuance in 2017 that closely matches the pace of issuance in 2016. The 30-year MMD index as of Friday was at a 2.98%, which is still well below the 10-year average of 3.71%. Now, rates have gone up since fall 2016 by approximately 60 basis points, reflecting an increase in the Fed funds rate in March, and also increased perceptions and evidence of inflation in the numbers that are released by the federal government regarding economic activity. We continue to see positive flows into bond funds, creating an attractive supply of cash ready to invest in bonds. And in fact, if you look at the expectations from June through August, the net supply is anticipated to be a negative $48 billion, meaning that the issuance less redemptions will actually see $48 billion on a negative basis in supply. So this sets a fairly strong backdrop in supply and demand dynamics just in the municipal market for an attractive time to issue debt for our clients. The expectation is that there will be a federal funds rate increase by about 25 basis points in June. This has been largely priced in, but we will see whether that actually transpires. Looking at the rating agency view on the market currently, Moody's and S&P currently have a stable outlook, but both indicate that there's a cloud of uncertainty regarding the status of the Affordable Care Act and the initiatives by current congressional leaders to change that, modify it, and it's still unclear what that may look like. Fitch has a stable rating with a negative outlook, slightly different take, but winds up in a similar place, stating that there is uncertainty regarding the ACA, and none of the rating agencies is making a longer-term or clearer indication until there's some resolution of some kind on the legislative front. If you look at the activity for S&P in their most recent rating updates for the sector, they have shown that 80% of their outlooks are currently stable, 11% are positive, and 7% are negative. And that's for their portfolio of credits, which I believe is approximately 406 different unique credits in the S&P portfolio. Turning to investors, we currently see that there is a desire for both the safety of AA category credits, but also the yield for BBB category credits. And so we're seeing strong interest in both those sides of the credit spectrum. And the A category credits are requiring a little bit more of a head scratch for investors, mostly to figure out and clarify the unique story of an A credit as to whether it seems to be the type of credit that may be on its path towards a BBB or on its path towards a AA. They are expecting a lot more and continued merger activity, and they are continuing to focus on an investor basis on what might occur on two fronts that have been fairly high profile in the news. Those are tax reform, which there's more of a raised eyebrow towards that. Tax reform has been a concern going back to when I started back in 1989, and is not necessarily materialized as a existential, actual impact to the tax-exempt financing arena. And what I think we see more of is concern about the regulatory front on the healthcare side. Some of the commentary suggests frustration with how opaque the legislative process is, and that there's a concern that there may be a desire to win rather than to enact sound policy. And it is very difficult for investors to know how to hedge against that. The fact that there are still many investors who have a lot of cash that they have to make work, they're still investing in the healthcare sector, and it remains to be seen what, if any, impact there will be on that flow of investment as healthcare reform takes shape in the Senate. One other dynamic that I think clients might be interested in making sure they review with their financial advisors and bankers and counsel is the use of investor calls and making sure that there is a dialogue about whether they are pre-recorded or whether they have live Q&A. There has been a little bit more of a drumbeat towards having live calls with Q&A live as well, rather than just recorded. And so that is a dynamic that is still case by case, but is swaying towards a more live investor call. With that, I'd like to turn it over to the next presenter, which I believe is Dave.
Thanks, Matt. This is Dave Bannard. Pardon my scratchy voice. I am indeed in Boston, and I had the privilege of taking my son to the Celtics game last night, so I'm about running on 50% voice. But that's okay. The Trump administration's actions clearly indicate a desire to reduce the regulatory burden on the nation itself, and certainly they've impacted the municipal market as well. The problem with these executive orders, however, is they have created a great deal of uncertainty in the market because, first of all, it's entirely unclear what the scope of these executive orders may be, and it's a little unclear as to how the members of the government are going to react. So we're going to skip through a couple of these. We're going to start with the very recent Executive Order 13789, which relates to tax matters. It was issued just at the end of April, and it requires that the Secretary of the Treasury undertake an immediate review of all, quote, significant tax regulations issued since January 1 of 2016. Interestingly, the term significant tax regulations is not defined in that executive order, and in fact, it goes to specific lengths to say that the prior executive order regarding OMB review of certain regulations is not controlling. It also is not clear as to whether certain other tax policies, such as revenue procedures or other kinds of guidance, are subject to this ruling. But within 60 days, an interim report needs to be submitted that identifies regulations that impose undue financial burdens, add undue complexity, or exceed statutory authority. And within 150 days of the issuance of the executive order, so by mid-September, the Secretary of Treasury is directed to report to the President regarding specific actions, which may include delaying or suspending the effective date of regulations or modifying or rescinding regulations. This is pretty substantial kinds of actions, and obviously creates a great deal of uncertainty in the market. We'll be discussing the issue price regulations, which are effective June of this year and were issued in the past December. They would certainly fall within the ambit of this guidance. There's another executive order that I think many of us are aware of that has also created some interest, if not consternation, in the market. And that's one of the first ones that President Trump issued. This is Executive Order 13771 that was issued at the end of January and is known as the 2-for-1 executive order. This one only applies to the executive branch and with certain exceptions. And I think that's fairly important for people to note because as it's pretty clear from this presentation, there still is a fair amount of rulemaking going on. This executive order requires that the total incremental cost of all new regulations shall be no greater than zero. I find that to be interesting, and I think most of the regulators find it to be daunting. That's a very difficult goal. And the other key requirement is that for every new regulation proposed to be adopted, 2 existing regulations must be identified for repeal. I'm referencing a memo that was issued by OMB's Office of Information and Regulatory Affairs that clarifies this. One of the interesting characteristics of each of these executive orders is that they are very broad and very general, and so this clarifying memo does drill down for the lawyers in the group to help us understand a little bit more about what some of these terms mean. So when it talks about executive branch and certain exceptions, it uses the definition found in federal statute. Significant regulatory actions are defined, and the exceptions such as military, national security, or foreign affairs functions or emergency actions are stated with some clarity. It also notes that the cost savings may be banked so that that if an agency will issue a regulation that would result in a cost saving, they can hold that over for future use. I'm going to try to skip through some of these fairly quickly because I really want to spend some time focusing on the proposed amendments to SEC Rule 15c2-12. These are pretty substantial, would cause a pretty substantial change in practice, and I think are really worthy of people's focus. I'll note that the deadline for comments was yesterday, and I'm relatively certain that the SEC's inbox is now quite full. By way of background, Rule 15c2-12 applies to underwriters of municipal securities. As I think most people know, the federal statute known as the Tower Amendment prohibits the SEC from regulating municipal securities by requiring a pre-filing of documents with the SEC. However, 15c2-12 achieves that goal indirectly by requiring underwriters to obtain a continuing disclosure undertaking from issuers that provides for 2 things. One is annual reporting, which typically requires that the issuer report their annual financial statements, audited statements, and second, that they update certain key tables or charts that appeared within the official statement. The understanding has been for some time that the annual continuing disclosure should mirror what is provided in the official statement. In addition, 15c2-12 requires the issuers report what's known as 14+1 listed events. The +1 is a failure to file an event notice within a timely manner of any of the other 14. These typically relate to the securities that are being issued. So a draw on debt service reserve fund, a replacement or substitution of a letter of credit, using a new trustee. It can also relate to adverse determinations by the IRS or bankruptcy determinations. But recently, several additional events were added, such as a merger. The proposed amendments to the rule would add 2 new events, and I'm going to take a little bit of time just to kind of go through these because this is rather densely packed language. The first new event would be incurrence of financial obligations, if material, or agreeing to covenants or other provisions that affect security holders, if material. So we'll get to the definition of financial obligation. This is the key to these proposed amendments, and it is extremely broad. But the other two issues to kind of pull out here are the materiality standard, which we will also cover a little bit. This has been somewhat diluted over the years, especially through the recent MCDC initiative. The other key here is the covenants or other provisions that affect security holders. The purported idea here is to address the prevalence of direct placements or bank loans by participants in the municipal market. And the concern has been that parity debt is being placed with banks, and in certain situations there has been some concern that the banks, through a continuing covenants agreement, have obtained covenants from issuers that may be different from those that are contained in the standard indenture or other bond documents, and in fact may put the bank in a more fortuitous or advantageous position.
Dave, a quick point on that. Has the SEC released any sort of guidance, or has there been any interpretation as to the form of disclosure under 15C212? Is there a suggestion that the entire continuing covenant agreement would be posted, or that borrowers would be required to post summaries of those covenants or events of default that the SEC seems focused on?
It's a great question, Heidi, and I think one of the things that is making many of us in the market kind of nervous is that the SEC is providing basically little or no guidance on that. But we all understand that the anti-fraud statute, Rule 10b-5 applies to any filings that are made. So we'll get into that in a second when I talk a little bit about tips for going forward under this, because that is going to be a really important issue if these amendments are adopted as proposed. The second proposed amendment would relate to financial obligations, and it says occurrence of the following under a financial obligation, quote, default, and note that this is not an event of default, it's a default. And to lawyers, a default is usually something that happens earlier in time, and so it's an occurrence of something that happens that may be curable, that time may have to pass before it actually allows remedies to be undertaken. So a default is typically a fairly early period of time. We also have a number of other events, including acceleration, termination, modifications of terms, and then my favorite, or other similar events. Again, a very, very broad category that is not defined. And in each of these is supposed to be limited by the qualifier that they reflect financial difficulties. So let me move on to the definition of financial obligations quickly. This is the key term here, and it is defined to include debt obligations other than those that for which a filing has already been made under EMMA. So basically, if you filed an OS with the MSRB, you're good. But it also includes leases, and the commentary of the SEC includes both capital and operating leases. There's been some speculation that that could be read so granularly as to apply to a copier lease. Guarantees, derivative instruments of all sorts, not just swaps, and the last one being monetary obligations resulting from a judicial, administrative, or arbitration procedure. In other words, legal actions, and again, there is no guidance as to whether this is a final or a preliminary decision and whether appeals must be undertaken before this filing would be required. And then, as I mentioned, the materiality qualifier. What I want to highlight about that issue is that under the MCDC initiative, issuers and underwriters of municipal securities were given a pass by the SEC. In essence, they were given much more favorable settlement terms if they reported instances within the last 5 years of failing to report the +1 event. In other words, failing to report a material misstatement or omission in an official statement regarding prior compliance with continuing disclosure compliance. The guidance issued through the 72 settlements with issuers and 72 settlements with underwriters seems to indicate that things that are really relatively minor would be considered to be material to the SEC. And that has really concerned the market. Furthermore, the vast majority of the underwriters in the municipal market, I think the underwriters are responsible for underwriting something in the order of 95% of the municipal debt offered in the last few years, settled with the SEC, and each one of them was required to undertake a program where they engaged an outside professional to help them beef up their due diligence procedures. And the net result of that has been, for participants in the market, that the underwriters are really drilling down on the filings. They're examining them closely, and if they find that anything was even slightly late, or if there is something that they think should have been reported, even if it was not terribly important to an investor, they are requiring that these filings be made. So we're finding the underwriters are doing exactly what they're supposed to. They are policing the market. But that is having a significant impact on the concept of materiality. So to get back to Heidi's question, here's some practical impacts on issuers if these requirements are adopted. The first is, as I mentioned, the materiality standard. This is not a bullet up here, but I'll emphasize it. After MCDC, I think the consensus is going to be that if there is any financial obligation, it's going to be important to make a filing because if you don't, you run the risk of underwriters second-guessing you. If there are subsequent enforcement actions, the SEC may do the same. Another point is that these events must be filed within 10 business days of quote-unquote incurrence. That is a very short period of time for almost any issuer, and is going to require, in order to comply with that, regular, weekly, if not more frequent, monitoring of the issuer for these kinds of disclosable events. So finding out when there has been a judgment, finding out when a new lease has been entered into, setting up an internal process to alert the person who needs to make those filings is going to be a challenge. Another question that I raised earlier is when did a financial obligation, when was it incurred? Well, one of the questions is going to be relating to judgments. If you are in a trial court and have a judgment rendered against you, but you have grounds for appeal, I think the answer that most of us would give is that although that is not a final judgment, it would be prudent to file within 10 days. And then in order to avoid confusing the market, you'll have to monitor the appeals process and file notices as you go along when there are matters to file. Similarly, defaults are sometimes not as clear as one would like, but and finding out when a default has happened and finding out how best to disclose that so that it's accurate, complete, and doesn't spook the market is going to be an interesting challenge. All of that leads me to recommend that issuers revise or adopt procedures relating to disclosure. This is really going to be critical. Those procedures ideally should include the party responsible internally for filing disclosures, and a process for identifying each of these events and communicating them to that party, training for the staff involved, and setting up all of these processes and procedures so that they can be followed. And I guess the other point that often goes without saying but needs to be emphasized is these processes and procedures are useless if they're not followed carefully.
Dave, one item that you didn't touch on that I think may be relevant, I'm assuming that this is all on a go-forward basis. Obviously, many listening, and for those of us who are on the calls that represent clients with hundreds of leases and, numerous private placement agreements, derivative arrangements. Is there a look back? Is there a requirement to bring forward and post on Emma summaries of the existing arrangements, or is the current view that it really is just on a go-forward basis?
Great point. I think the current view is that it's a going-forward basis, and the current draft of the amendments would make them effective. Would require filings 3 months after the effective date, so that it would give the market some time to adjust. So there isn't going to be a requirement that one of my airport clients reported that they have over 600 leases, and another one noted that one of their terminal leases had been amended 20 times in the last 10 years. Those 600 leases won't need to be filed immediately, but as new leases are entered into, they'll need to something will need to be filed with respect to them if they are material.
And maybe we can give Matt a few minutes, and during our Q&A time, circle back to him. I'd love to get some practical guidance as to whether healthcare borrowers are going to have a leg up, so to speak, to the extent they start off day one with transparency and provide some insight into those private placement derivative lease arrangements that they already have. So we'll circle back to Matt for his thoughts there, because okay. I do think it's an interesting point to be considered.
So the other question that's going to come up is what to file, a summary or a redacted original document. And part of that, I think, is going to be the amount of time that the issuer has to file. If you build this into your process, especially for certain transactions where you're going to have to make a filing, it may be possible to develop a good summary that allows you to post that summary. But if it's something that the filing officer finds out about five business days after it happened, I think the more likely outcome is that redacted originals are going to be filed.
Well, and to that point, I think bank counsel are already so primed for providing redacted documents of, say, letter of credit or other liquidity support documents that need to be provided as part of the MSRB requirements, that I wouldn't be surprised if, just for ease, at least as it relates to private placement documents, that bank counsel, provide redacted CCAs at the end of the transaction.
I think that makes sense, Heidi, but I just worked on a recent transaction where we did a DP, direct placement, and it was no additional covenants were given to the bank that purchased the obligation, and so we were able to post a very brief statement on Emma that gave the principal amount, the term, and a few other relevant provisions, but we didn't have to go through any covenants because there really were no additional covenants. So I think it's going to be a case-by-case determination. Let me move on because there's lots more to cover in the webinar, but it is an important topic. I also think it's important for not only for underwriters and broker-dealers who are, I know, quite aware of this, but for issuers to note that this is going to have a significant impact on their underwriters as well as broker-dealers that are marketing their securities, because under MSRB rules, a broker-dealer must have a reasonable basis for recommending a security to a purchaser, and that really implies, if not requires, that they review the materials that have been filed with Emma. And as I mentioned before, the underwriters are the ones who are expected to and are in fact policing this requirement. And so if it is in fact adopted, I think you're going to see a very, very significant amount of due diligence, which is going to add to the time, scope, and cost of that process. I wanted to take a minute to just talk about recent SEC enforcement actions, not because I want to drill down and take a whole bunch of specific lessons from them, but more to get your attention. And as I said to a recent group of people I was speaking to get your heart rate up a little and focus a little bit. The SEC's recent enforcement actions have included individuals almost without, with exception. My understanding is that staff has been told that the Commission wants there to be identified persons who can be prosecuted as well as the issuers. And furthermore, the SEC is seeking significant monetary penalties against both the issuers and the individuals. The most the biggest example I can give you was a mid-level financial functionary in the city of Miami who the SEC proposed a several $100,000 penalty against for alleged violation of the fraud requirements. The trial judge did reduce that significantly, but the SEC's position was that this individual committed the fraud, which the so-called fraud was basically moving money from one fund to another in order to make the general fund balance look better. There was certain evidence that was authorized, but in any event, this individual, according to the SEC, did it in order to maintain his lucrative six-figure salary, which was about $125,000, so considerably less than the average salary of the SEC prosecutor that was any SEC prosecutor. Another thing that's important to note is that in one of the early actions brought relating to municipal disclosure on the Orange County side of things, the Board of Supervisors in essence said, look, we had very competent working group, our staff, our bond counsel, the underwriters, we relied on them. That isn't it reasonable to do so? And the SEC's response in that enforcement action was, it's reasonable to rely on them, but you must ask them questions about issues that you believe to be material that are within your knowledge. In other words, there is not a requirement that every board member carefully read the entire official statement. I would argue that the SEC would like to write that into law, and that is the current position of many of the members of the Office of Municipal Securities. And if given a chance, I would push board members to read those documents and bring any issues to your attention when you're on a working group. But in any event, it's exceedingly important in the due diligence process to make sure that you've had a chance to interview those people. The last issue I'd raise is the importance of preserving attorney-client privilege. One of the things that is easy to forget when you're in the middle of a financing transaction is that some of the members of the working group are in fact adverse to the issuer. It doesn't mean that they don't like you. It doesn't mean that they're out to get you, but it means that their interests can in fact not be aligned with yours. And in a situation where information is disclosed, the attorney-client privilege can be lost. So if there's something that your attorney is bringing to your attention as the issuer, it makes sense to consider whether or not to make that available to the full working group without considering how best to redact that. I think that covers many of the lessons learned that I've got here, so I will follow up, and I'm just going to take a couple minutes to talk about the MSRB's proposed amendments regarding QSIPs. QSIPs are those ubiquitous numbers that appear on bonds. The first 6 numbers identify the issuer, and the last 3 are unique to that security. The MSRB has proposed amending its Rule G34, and what they're really trying to do, it's a two-parter. One is the one I'm talking about here is to make private placements subject to the QSIP rule. The MSRB's position is that private placements generally are eligible for QSIP numbering. Why is that important? Because many banks prefer to treat a direct placement as a loan rather than as a security. QSIPs have long been regarded by the market as an indication that an obligation is a municipal security rather than a bank loan. We've had sort of the benefit of having our cake and eating it too in the municipal market over the last several years, where banks have taken the position that an obligation is a loan, and issuers have taken the position that it was a bond and a municipal security. The proposed amendments to the QSIP rules may tip the balance in the other direction and may have an adverse impact on private placements if, in fact, these amendments are adopted. But it is worth noting that it's not clear that a direct placement where no placement agent is used is subject to the QSIP requirement. So if you are not working with a placement agent, which is defined as an underwriter or broker-dealer, and if you're working, for example, with a registered municipal advisor who advises you but is not acting as a placement agent, the issuer may, in fact, be able to place that debt with a bank on a direct placement basis without obtaining a QSIP number. I think that's something that we're going to monitor going forward and see more of. In the interest of making sure we get to all the other topics in this webinar, I'm going to turn it over to Mike to talk about some of the recent interesting tax developments.
Okay, thanks very much, Dave. In our remaining time, I'm going to address two tax regulatory actions. First, the new safe harbors for management contracts under the private business use rules, and second, the new issue price rules. These do apply to all different types of tax-exempt bonds. I'm going to focus, given our limited time, on particular issues that are important for qualified 501c3 bonds, the bonds that are issued for the benefit of 501c3 hospitals and other exempt organizations. Just a quick note before I launch into this is that these new regulations or published guidance are final, and they have pending effective dates. So most of Dave's discussion has concerned, proposed new regulations, which may or may not actually be promulgated. It appears we are going to have to be dealing with these final regulations unless they're short-circuited in some manner by the executive orders that we discussed, which is possible but not necessarily expected.
Mike and Heidi, before you move on, may I please read quickly the CLE code for this program? If you are in need of a CLE credit today, please enter the 5-digit code into the poll question on the screen after it is announced and press the Submit button. The code is as follows: HU as umbrella, J as in Julie, Z as in zebra, and 9. HUJZ9. Again, if you're seeking CLE credit for this session, please complete the polling question by entering the code that was just announced. The polling question will remain open briefly. For those of you seeking Kansas, New York, and New Jersey credit, in addition to the polling question, again, you will need to complete the attorney attestation form, and a copy of the form can be found in the resource widget. CLE attendance credits will be distributed to participants approximately 8 weeks after the web conference via email. Mike, I'd now like to turn it back over to you.
Okay. Very good. So this new Management Contract Safe Harbor Revenue Procedure 2017-13 sets forth a new framework that's different than prior guidance, basically the old Revenue Procedure 9713. It's in many ways more flexible than the old Safe Harbor, but in certain ways it's actually more restrictive. And in general, the guidance is much more favorable for longer-term management contracts, such as infrastructure contracts, but could be more burdensome for certain types of shorter contracts. And I guess I would note that in the 501c3 area, it's very common to have to address many different types of service contracts related to bond finance property, be they physician contracts, food service contracts, other types of contracts. Usually in the 501c3 context, the contracts have a shorter term, and so the particular new requirements for contracts with short terms have particular importance in this sector. Just a brief review. In general, the rules for qualified 501c3 bonds place a general 5% limit on private business use. The new revenue procedure provides a safe harbor under which management contracts don't reside in private business use, and this revenue procedure supersedes the prior revenue procedures. Just before launching into the discussion of the safe harbor, it's important to bear in mind that the revenue procedure establishes a safe harbor. It's not a requirement. And so there is an interplay between what the regulations say and this safe harbor. And generally, this new guidance does not change what the regulations say about when service contracts result in private business use. So one of the key things is that the regulations say a management contract results in private business use if the contract provides for compensation for services based in whole or part on a share of net profits from the operation of the facility. Certain incidental contracts are accepted from being treated as private business use. And then the regulations also say that if the service provider is treated as a lessee in substance or as an owner or as a partner, really, the service contract will be treated as resulting in private business use. Otherwise, the regulations have a vague facts and circumstances test. And the revenue procedures have always been intended to sort of fill in some guidance within that vague facts and circumstances test. It's important to bear in mind that all of this discussion is within the framework of what the regulations say. The new safe harbors can be used immediately, but they are required to be used for contracts entered into on or after August 18th, 2017, and not materially modified after that date. And a special transition rule applies for contracts entered into prior to August 18, 2017, if they're extended generally, and they can be extended pursuant to an option that one party has a right to extend the contract after that date. So generally, there may be a question about which contracts can still qualify under 9713 and which contracts have to be tested under the new revenue procedure. So the existing 9713 basically had a framework based on term of the contract and type of compensation. The basic theme was that you could have a longer term to the extent a greater portion of the compensation was fixed. And there were safe harbors for 2-year, 3-year, 5-year, 10-year, and 15-year contracts. That whole approach was sort of like a practical nuts and bolts approach. It didn't really reflect in concept what types of contracts might be deemed to be leases or what types of contracts might be deemed to be partnerships. So now a much longer 30-year term is permitted. The whole structure of focusing on the extent to which a fee is fixed is superseded. And instead, there's a set of new requirements relating to control, no bearing of net losses, risk of loss, no inconsistent tax position. Basically, factors which are intended to establish that you really have a service contract and not a lease or a partnership. And then there's another rule that says the contract can't have a term more than 80% of the reasonably expected economic life of the managed property. So one of the principal reasons for this new safe harbor was to facilitate public-private partnerships for infrastructure. And in those cases, it may be common to have contracts longer than 5 years, and there was in particular call to have those contracts be permitted to have variable compensation. The new revenue procedure accommodated those longer-term contracts, particularly for infrastructure, but does raise some practical problems. There's actually technically two safe harbors, a principle-based safe harbor that permits up to 30-year term, and there's another safe harbor for instances when the only fees paid to the manager basically are as reimbursement for expenses. I'm focusing on the first in this presentation. So the new safe harbor requires a number of terms that didn't apply under the old safe harbor, and particularly for contracts under 5 years. So there's a rule that applies to say the term of the service contract can't be more than 80% of the economic life of the managed property. There are new requirements that the organization control the use of the property, that the service provider not bear risk of net of loss, that the risk of loss of the managed property is basically with the exempt organization, and that the service provider doesn't take any inconsistent tax position. Those are all new requirements for contracts of 5 years or less to fit within the safe harbor. In addition to that, the new revenue procedure in effect provides a gloss on the requirement that's in the regulations that says that the compensation can't be based on net profits. And basically, this gloss is a very restrictive one, and it basically provides that under the safe harbor, you can be treated as having a compensation based on a share of net profits if compensation is triggered by a net profits factor. So for example, the service provider wouldn't need to be paid a percentage of net profits to have a problem under this rule. But if a contract said the service provider is paid an additional fixed fee if some net profit standard is met, would still be a problem under the safe harbor. The new revenue procedure clarifies that certain types of previously permitted compensation arrangements won't be treated as net profits arrangements, including capitation fees, so-called periodic fixed fees, and per unit fees, and that there's a rule that permits deferral of compensation basically for up to 5 years if certain conditions are satisfied. And that is sometimes important with 501c3 bonds. The safe harbor also provides a rule that says that the service provider must agree in the contract that it's not entitled to and will not take any tax position that's inconsistent with the service provider to being a service provider to the qualified user. And these magic words have to be in all service contracts relating to bond finance property to be in the safe harbor. So we have certainly been advising, say, clients to put this into their form service contracts so that there won't be any question about whether at least that portion of the safe harbor is met. So, particular issues for 501c3 bonds: interpretation of the term limit, the 80% of recent expected economic life. We never had that for shorter-term contracts. One of the issues is, say, you're entering into a radiology agreement, and there's a item of equipment that has a 10-year life, and you want to enter into a new contract 7 years within the life that has just a 3-year contract with equipment having a 3-year remaining life. Is that going to be a problem under this new safe harbor? And there have been different views expressed about what the managed property is, but there will be questions raised about whether a contract technically fits within this 80% rule, depending on what the managed property is. Again, all of this is a safe harbor, but it's important to note that in some cases, this requirement of the safe harbor might not be met. The service has stated more clearly than the past that if a contract provides for compensation based on gross revenues, where the service provider pays the operating costs of the actual finance facility, that may be treated as a net profits arrangement. The no net profits rule is more strictly stated than in the past, and then, of course, the so-called magic words regarding no inconsistent tax position ought to be in the contracts. So, in general, that the new revenue procedure establishes fewer bright lines than the old 9713 revenue procedure, and my view is that it will likely require more interpretation by issuers, borrowers, and counsels. This principle-based framework will likely raise new interpretive questions, and there may be more need than under the old revenue procedure for counsel to adopt positions that contracts that do not exactly meet all the safe harbor requirements still do not result in private business use under the facts and circumstances. And maybe one point to raise about this is that some bond documents have required in the past that all contracts meet a safe harbor under 9713 unless, for example, an opinion is provided. That may be unduly burdensome under this new regime, where it may not be that uncommon for some contracts to fail to meet one of these standards, particularly the 80% useful life standard, but still counsel and the organizations will be comfortable it shouldn't give rise to private business use.
Mike, I've already given the CLE announcement, so let's just move on to issue price.
Okay, the new issue price rule are final regulations, which were published on December 9th, 2016, and they will apply to bonds sold on or after June 7th, so the effective date is coming up very quickly. Just a few general notes about the new issue price rule. It's definitely more complicated rules for negotiated public offerings, somewhat simpler rules for direct purchases and loans. New rules also have special provisions for competitive public offerings that don't typically apply to 501c3 bonds, so we're not going to discuss the new rules for competitive offerings in this presentation. Again, the effective date is bonds sold on or after June 7th, 2017, so it's coming up. And a general just practice note, it's important to resolve issues about how these new regulations are going to be applied well in advance of the sale date or the date a bond purchase contract is executed, particularly during this transitional phase where these new rules will first be applied by issuers, underwriters, and counsel. SIFMA and NOBL have released very detailed forms that will likely serve as a starting point for many counsel, but many counsel probably will have revisions to these forms in particular circumstances. Again, the effective date is coming up very quickly. The new regulations will significantly affect the process for selling tax-exempt bonds, particularly in public offerings. And many questions relating to these new regulations have not been completely resolved in our view. Just thought I'd take a moment to sort of describe what the issue price rule is actually about. And one way of looking at the issue price rule is that it concerns the amount of proceeds that an issuer is deemed to receive. And the amount deemed received is typically greater than the actual cash proceeds received. So, for example, if an issuer offers its bonds at 100 and receives from the underwriter 98, the proceeds are treated as 100, not the actual cash receipts. In other words, the underwriter's discount is treated as part of the proceeds of the bonds. Now, that's a rule that many in the industry are familiar with. It's been basically required for more than 30 years. But one way to look at this issue price rule is it's really about how much the underwriter is deemed to receive. And because the issue price is the starting point for the application of many of the tax-exempt bond requirements, it's usually important to know it on the date the bonds are sold, or at least on the issue date of the bonds. That's been the view historically anyway, that it's important to have everything wrapped up by the date the bonds are issued at a minimum. Now, the existing regulations follow the general rule that the issue price is the first price at which a substantial amount of bonds is sold to the public. 10% is a substantial amount. The issue price rule applies separately to substantially identical bonds. That's generally applies separately to each maturity of bonds, which makes its application somewhat more complex. In the case of bonds for which a bona fide public offering is made, the existing rules state that issue price is determined based on reasonable expectations as of the sale date. Well, why do we even have these new regulations? And the main reason appears to be that the IRS didn't like a rule based on reasonable expectations. They thought it was too difficult to administer a rule that just looked to expectations rather than actual sales. And all of this complexity in these new regulations is evidently intended to get around a rule that is based on reasonable expectations. Actually, I just note that in concept, it may be that a rule based on what the reasonable expectations are at the sale date is sort of the most accurate measure of what an underwriter is deemed to be paid. Nonetheless, the IRS got rid of the reasonable expectations rule, but they inserted two other rules that were intended to enable the issuer generally to know what the issue price was by the issue date. For underwritten bonds with a hold the offering price requirement, and there's a special rule for competitive sales. I also note there are different possible interpretations for exactly how the 10% rule works, and if we have time, we'll get into that. So, because 501c3 bonds are rarely issued in competitive sales, it's usually going to be the rules for negotiated sales or directly purchased that are going to be relevant. And as I indicated, the rules for direct purchase bonds are somewhat simpler, but the rules for underwritten bonds are much more complicated. And so let's get to the so-called hold the offering price rule. One question is, when and under what circumstances will the borrower decide to use the hold the offering price rule as compared to just establishing issue price based on actual sales? And the problem is that if the issue price is based on actual sales, you might not know what the issue price is on the date of issuance or on the sale date. So the hold the offering price rule was intended to be sort of a replacement of a rule that permitted the issue price to be established on reasonable expectations, but it's much more complex than the old reasonable expectation rule. So for bonds that are offered to the public, the issuer may establish the issue price as of the sale date. Each underwriter agrees that it will neither offer nor sell the bonds to any person at a price that is higher than the initial offering price for a period to the public during a period starting on the sale date and ending on the earlier of the close of the 5th business day after the sale date, or the date on which the underwriters have sold a substantial amount of bonds to the public that is no higher than the initial offering price to the public. Again, this rule applies basically on a maturity by maturity basis. So if the issuer does that or the borrower does that, then the issue price will basically be the price at which the bonds are offered. If the holding offering price isn't used, the issue price will be determined based on actual sales, which may be different than the public offering prices. It is possible the issue price might not be known on the issue date if 10% of the bonds isn't sold, or maybe long after the issue date. It might not be possible to determine bond yield or the amount of proceeds on the issue date, and whether the holding offering price is applied may depend on pricing considerations, bond counsel requirements, or borrower policies. So how does this play out in actual practice, particularly for 501c3 bonds? And one issue is I think there's a general consensus that most advance refundings will likely be required to use the holding offering price rule if they're negotiated sales, because you usually need to know the bond yield on the date of issuance. There might be ways to do advance refundings without the holding offering price rule, but it would be difficult. One issue that's arisen particularly for 501c3 bonds is that it's a rule that says no more than 2% of the proceeds can be used for cost of issuance. That's one that I think is possibly problematic, because basically the issue price rule, as I indicated, is largely about how much the underwriter is deemed to be paid. So for example, say an underwriter says, I'm going to offer your bonds at that are 100, I'm going to offer them at 102, and the underwriter ends up selling them at 103. There's a concern that the deemed amount paid to the underwriter as compensation would be more than the 2% permitted, and would that cause the bonds to be taxable? I note, one point is that these regulations literally state that they only apply for arbitrage purposes, the rules relating to investment of bond proceeds. But most counsel have used the issue price for a variety of other purposes, and I think that will be the prevailing view of bond counsel, although that's an issue that will need to be sorted out. Some people have raised issues about bank qualified bonds, where you need to know that the amount of the bond is not greater than, say, $10 million, and how, if you have a bond that's getting close to that limit, it may be necessary to use the holding offering price rule, or in all cases have a direct purchase for those type of bonds. So will workarounds be available? That is a question that we have been discussing. For example, can the issuer, if it doesn't know what the issue price is, set aside an amount of its own proceeds, say 2 or 3% more of its equity, and be prepared to spend those amounts on qualifying costs if the issue price is higher than expected? There are possible workouts, but they entire complexity. So I did want to just address a few points about the issue price regulations in conclusion. One is that there's some perception that the holding offering price rule may cost issuers and borrowers additional interest expense. We understand from underwriters and others, and maybe Matt can weigh in on this, that the actual Additional cost for the holding offering price rule depends on the facts and circumstances, the type of bond, the nature of the issuer, whether the bond issue is oversubscribed, and so forth. But we have heard from the underwriters that there may be some additional cost. So there may be pressure to try not to use the hold the offering price rule unless it's absolutely necessary. That necessarily will entail basically a dialogue between the organization, bond counsel, the underwriters, likely also the financial advisors, just sort of weighing the amount of additional interest cost to the additional for using the hold the offering price rule, to the additional complexity of not necessarily knowing what the issue price is on the issue date of the bonds and having to develop some of these workarounds, which may require another post-issuance obligation of the borrower. So I just would like to summarize a few points. One is that generally, we've been discussing both proposed and final rules. Dave in particular discussed many of the proposed securities law rules. Most of the tax rules we've been talking about are actual final rules, which have looming effective dates. And in that respect, I think these final tax rules are more imminently important, but the securities law proposed rules do send a signal of where the industry may be going in the future. Some of these new rules really weren't issued in response to requests from the bond community. In particular, nobody wanted this new issue price rule. It's not something that the industry wanted. It's something that the IRS thought was necessary to address a perceived abuse. This may be a factor in leading to more rigorous review under the recent executive orders. We don't know. Interesting, most of these new developments are sort of elaborations and extensions of existing rules. In some respects, they're more flexible, but they are more complex and possibly more costly to apply. The issue price rule in particular is flexible to the sense that you can sort of pick or choose which rule you want to use, but it's definitely a more complex process to use it for negotiated public offerings. All of these new rules pose particular additional burdens for public offerings of tax-exempt bonds. Particular, the proposed 15C212 regulations and the new regulations on issue price. And one question we have is whether it's possible that these new rules will result in a greater use of direct purchases and bank loans as compared to public offerings, because in some cases, the complexity may be daunting to some 501c3 organizations, particularly smaller 501c3 organizations. And as I noted, these new rules may pose particular problems for smaller borrowers because they may not have the wherewithal to deal with some of the complexity of these new requirements. So Heidi, did you want to open it up for further questions?
Yes, and before we get to questions, it's time for the second CLE Code announcement. If you are in need of CLE credit today, please enter the 5-digit code into the poll question on the screen after it's announced and press the submit button. The second code is as follows: 87Y as in yellow, D as in David, K as in kitten. 87YDK. Again, if you're seeking CLE credit for the session, please complete the polling question by entering the code that was just announced. The polling question will remain open briefly, and again, for those seeking Kansas, New York, and New Jersey CLE credit, you are required to complete the attorney attestation form. Enter the 5-digit codes and return the form to Kristen O'Neill at KONEILL@Foley.com after the program. For my presenters, we have received a question from the audience. Dave, I think this one is for you. Does the amendment to the MCDC affect the calculation of materiality? So as it relates to the proposed changes to 15C212 and then the recent MCDC initiative, what's your view on how all of that affects the calculation of materiality?
I think that's a great question, and I think that the MCDC initiative has definitely affected the concept of materiality. I think that most practitioners looked to the guidance in a long line of SEC cases, and basically the standard was if a reasonable investor would take this into account in determining whether or not the information would affect their decision to invest in a security, then it was material. But and so it had to rise to some standard. Now, what exactly that standard was a little hard to determine, but I think it was fair to say that if somebody failed to file a notice of changing the trustee within 30 days, most investors would not say that that was going to make a big difference in whether or not they were going to buy a bond. However, according to the guidance issued by the SEC, a failure to file within 30 days could indeed be a material misstatement if you say that you fully complied with your all the requirements of your continuing disclosure undertaking. So the net effect of that, I think, is that in an abundance of caution, most issuers are going to file anything that could possibly be conceived to be material, and that's pretty much going to mean everything. And I think that's been the gist of a lot of the comments that I've seen. We've worked on comments of several groups that were filed yesterday. And I think the gist of it is that if you have a really broad definition of financial obligation, such as set forth in these proposed amendments, and if you haven't clarified what materiality is to kind of bring it back to what people used to think it was, then the net effect is going to be that any time an issuer incurs any kind of debt, enters into any kind of lease, enters into any kind of derivative obligation, etc., they're likely to file a notice, or more likely, they will file a redacted version of the documents relating to that. And really, what the net impact on the municipal market is that there will be a huge amount of information filed that then they have to sift through. Now, I note in today's bond buyer that the National Federation of Municipal Analysts took sort of an interesting bifurcated position. They took the position that all notices of all debt obligations entered into should be filed. I think implicitly what they're saying is, let us determine what's material. We want to see it. And then everything else, well, yeah, we'd like to know about other financial obligations, but only if they're material. So they seem to be kind of reverting back to, we'd like material to really mean something, but from the NFMA's standpoint, any debt obligation is important for them to understand.
Thanks, Dave. I think that fully answers that. Turning to another question, and Matt, would love your thoughts here. We touched on this earlier, but in terms of the cumulative impacts of the proposed and final regulations that we've discussed, what's your view on how all of these changes might affect the municipal market? Do you see the initiatives driving more issuers into direct placement or into certain types of structures as it relates to publicly issued bonds? And Dave, I guess to that end, I know that you had a recent experience, restructuring a transaction in light of issue price rules. So would love this group's thoughts on the impact all of these changes are going to have on different structures.
Well, Heidi, I'm going to take that initial request for me to take a shot at this, and then turn it back over to Dave. first things first, going to the issue price requirement, my concern for clients will be that underwriters will have less of an incentive to actually underwrite transactions in volatile markets, potentially. And it's not like there's been an awful lot of underwriting going on, but this takes a federal rule and messes with a market dynamic that may be important to issuers looking to lock in funding in volatile market situations. So, or the cost of doing something like that could be much higher depending upon the circumstances at the time of issuance. And I think it'll be difficult for financial advisors and clients to really be able to tease out what that additional cost might be. In a more practical deal-by-deal situation, regardless of the potential volatility of the market, is whether certain structures are obviated because it will be more challenging to track the issuance price. And I would just throw in as examples the 5% coupon structures, which tend to be the most favored coupon structure for long-term bond funds, as compared to the 4% coupon structure that tends to be favored by investors that may have less of a longer-term view of participating in a particular security, and results in a little bit more secondary market trading than the 5% coupons. And the reason why those two options are meaningful is that issuers who are looking at the minimizing their yield to the call date might favor the 5% coupon structure because it tends to have a much lower yield to call than the 4% structure, which actually has a lower yield to maturity. If you're a CFO looking at where our rate's going to be, having access to two different mechanisms to fund, one that favors a longer-term view and one that favors a more near-term view, allows you to not have to be right, but to diversify your issuance among two products that allows you to split the difference. If you have a particular bias that is yield to maturity or yield to call, potentially you could use one product to the exclusion of the other. But in a situation like this where you might need to determine the issue price up front, it may create some difficulties in accessing some structures that allow you to diversify your existing holdings, either because of rate view or because of investor interest. And I might point out, most of this issue price certification has to date been after the fact, largely just a certificate that the underwriter signs and is fairly standard practice. And now this discussion may drive finance plan considerations in a way that is unfortunate because it's an obscure but important rule rather than an actual mechanism of the market.
Yeah, Matt, this is Mike Bailey. I'd just like to emphasize, too, that this is, in some respects, an extraordinarily intrusive regulation because it actually affects how bonds are sold and marketed. And I can't think of another tax regulation that has done that. And so it will have some additional costs for borrowers. It's hard to quantify those costs because, as you say, it will depend on market conditions and how an organization is situated and so forth. But it's perceived to have some costs. I would say that it may entail some additional post-issuance obligations of borrowers, particularly in cases where the hold the offering price rule isn't used. In general, this proposed 15C212 amendment would, I think, impose much greater post-issuance costs as a practical matter, but maybe the upfront costs are higher under this issue price rule. it's problematic. It is sort of interesting that so many of the comments under the 15C212 proposed amendments were scathing criticisms, and in particular focused on the massive additional costs that would be imposed on issuers and borrowers if the regulations were finalized in their form. Interestingly, I don't know quite why this is. There wasn't quite the same uproar under the issue price regulations. Now they're proposed to be final unless they're yanked under one of these executive orders. Nonetheless, both impose costs sort of in different ways, and in some respects it's maybe more difficult to estimate what the costs are. I mean, but if you assume that someone comes up with some measure of what the additional costs are for the hold the offering price rule, whether it's 5 to 10 basis points or whatever, and spread that across the whole market, that's a huge additional cost imposed by these regulations.
Yeah, I also think, Mike, that one of the issues that, and Matt alluded to this, there's always been something of a tension between trying to price an issue efficiently so as to get the lowest interest cost for the issuer, and yet to be able to market it efficiently so that underwriters didn't have large unsold amounts of bonds. This is going to exacerbate that because especially where issuers really need to know on the sale date what the issue price is, there's going to be a lot of pressure to have a slightly richer price so that the bonds can be so at least 10% of each maturity of the bonds can be sold, rather than trying to skinny out the interest rate as much as possible so that you can really most efficiently price the bond deal. And I think there's going to be real challenges for all the participants in the market, but it does create another difficult dynamic.
Gentlemen, I know that we could go on for at least another half hour on this topic and others that we covered today. And unfortunately, we only allotted 90 minutes for the call. So I'd like to wrap up by inviting the participants on today's call to contact any of today's speakers if you have additional questions or if you would like more information on particular topics. This does wrap up our web conference today. Just a reminder, today's program is being recorded and will be available on Foley's website in the next few days. At the conclusion of this program, a questionnaire will appear. Please take a minute or two to give us your feedback on the presentation today. It is important to us to know your thoughts, and it certainly helps us shape our programs going forward. I'd like to thank all of our presenters, especially Matt, for taking valuable time out of your day. I'd like to thank those in the audience who joined us. If you have any questions regarding this program, please contact Kristen O'Neill at KONEILL@Foley.com. Thank you for your participation, and we look forward to hearing from you during our next webinar. Thank you.